Hello, everyone, and welcome to Currency Exchange, a NatWest podcast series all about foreign exchange markets. I'm Brian Daingerfield. I co-head G10 FX Strategy at NatWest. I'll be your host today. Today, I'm happy to be joined by Eimear Daley, who heads our EM strategy team over in London, to talk about all things emerging markets and the dollar this week. It's been a very busy one, certainly here in the U.S. with the passing of the tax bill in the House and higher long-term yields. So, Eimear, thanks very much for joining for today's conversation.
Thanks for having me, Brian.
So maybe I'll just start with a couple of broad lines on the dollar and, the tax bill that was passed this week, because we've seen the dollar weaken against most currencies this week as we consider a big move higher in long-term yields, not just in the U.S., but across a number of economies this week. Among the drivers of that has been the really quick move of the House Republican tax bill through the Congress. So just for context, the text of the bill, the full text was released just recently, and we've now had this bill passed as of this morning as we record on Thursday morning, the 22nd of May. So House Republicans have pushed this bill through at breakneck speed. And I think what we're seeing from markets, particularly in the long end of the Treasury curve, is that markets' assumptions about the sort of deficits and the concerns around debt and deficit dynamics in the U.S. have sort of reared back into focus as we think about this bill. Of course, over the weekend, we also had a downgrade of the U.S. sovereign credit rating, which happened at a pretty consequential moment, given the release of the text of the House bill, and sort of maybe adding a bit to those concerns about deficits and deficit reduction and lack thereof here in the U.S. So on the cyclical side, we had seen over the last couple of weeks the dollar maybe find a little bit of footing here, simply because the economic data that we've had hasn't really yet shown material signs of slowing. And in addition, we've had this major de-escalation on the trade side that has really reduced the tail risk, the downside tail risk to the U.S. economy. So we've seen markets pare back their expectations for Fed easing this year and pare back this sort of implied risk that the U.S. is going to be hurtling towards an imminent recession due to tariffs. We've seen that big de-escalation. And in general, we've seen different currency groups have reacted differently to that. And we'll talk about EM in just a second, Eimear. But from the dollar side, we have seen a little bit of consolidation in a number of these dollar pairs. The dollar has strengthened a little bit in some of these cases. But more recently, we've seen higher long end interest rates have actually weighed on the dollar a little bit here, which is a difference in what we had seen in previous instances of higher long-term yield. So one of the things that's accompanied this move higher in long-term interest rates is a rise in the implied term premium, this idea of the additional compensation that investors are required to hold long-term assets relative to short-term ones. What's interesting is that in past instances of higher term premium, those have been associated at times with a stronger dollar, simply because higher term premium tends to be associated with periods of higher market volatility, higher volatility in interest rates, differentiated expectations for the development of interest rates. And higher volatility tends to be something that has strengthened the dollar in the past. But this is one of many dollar correlations that has shown signs of weakening or outright breaking in the aftermath of April 2nd tariff announcements, the Liberation Day announcements. And in addition to short-term yield differentials where relationships have weakened, U.S. versus equity correlations which have shifted, and also U.S. versus these sort of long-term term premium questions. These correlations have all shown signs of changing, and I think that speaks to a longer-term, structural concern around dollar valuations. The dollar is still very rich on multi-year valuations. We do think there continue to be signs that international investors are looking at the dollar portion of their U.S. asset portfolios differently, maybe hedging more of that currency exposure, reducing their outright exposure to the dollar as part of their holdings of U.S. assets. And so I think these structural concerns for the dollar remain here as we eye the dollar showing some signs of weakening here against some of the G10 currencies, even though the cyclical picture has clearly improved since we've seen this de-escalation in trade tensions, and some of the hard data have remained resilient here in the U.S. in the face of a lot of uncertainty coming from confidence measures, whether it be consumer or business confidence. So, Eimear, I want to bring you in here to talk about emerging markets. I know that you've been bullish on emerging markets broadly. Is that still your view? And are there any currencies in the region that you think really stand out as potential outperformers?
Yeah, I would say we're kind of cautiously bullish, broadly on emerging market currencies. And I guess there's kind of five key points that really underpin our view. I think as you mentioned, we're kind of past that peak of global trade tensions, and we do think, future developments are going to shift towards progress towards trade deal and actual agreements being announced. I guess the second point would be we think, local EM policymakers are going to be really concerned about the risk of being labeled currency manipulators. And I think we've seen a number of incidents now in emerging market currencies where you would have had quite a managed currency regime or a managed float, and actually markets have been really taken aback by the fact that central banks haven't been there to kind of stem, volatility periods. And we really think that is because they're so concerned about this kind of impeding a trade deal. I would say on the back of that as well, kind of after Liberation Day and that kind of initial aftermath, we saw, rates markets globally really price in this trajectory of significant easing and significant rates cuts. We think in particular in EM, that is mispriced, obviously because of that risk of currency manipulation, but also because emerging market economies are so exposed to kind of capital flight, broad-based currency depreciation. So they will be really kind of nervous and hesitant to enact, front-loaded easing policies in this environment. I also would say, kind of our fourth point, and one you alluded to, is we do think that EM kind of life insurance and financial institutions will look to increase dollar hedging going forward. I think Taiwan kind of stands out as the example where you had reports of significant mark-to-market losses by life insurers there because of significant exposures to US assets which were unhedged. And then I would say, the fifth point is, China has kind of consistently looked to limit depreciation pressure, and that is kind of an anchor of currency stability for the whole of the EM complex. So we think that holds true. I guess, where we are the most bullish is kind of on those risk-sensitive currencies. So things like Korean won, Indonesian rupee, South African rand, Brazilian real, where we think, they are sensitive to those global growth outlook, and we think they're trading undervalued, and we think there's kind of the most mispricing by central banks. So that's where we are at the moment. But Brian, I have to bring you in on that point. If I get one pushback from investors over my kind of bullish EM view, it's over the case of, and the question of, are we past the peak of, global trade tensions? Is there the risk that the US kind of escalates from here? And I guess you are the authority on all things US trade policy. So just to pull you in on this one.
Yeah, so I think, we've obviously gone through major ebbs and flows on trade policy. And I think right now we're certainly in a de-escalatory phase. And my sense is that we are reaching or at the peak of that de-escalation. So you think about the tariffs that have been imposed and what's been taken off so far. The reciprocal tariff regime, now that the de-escalation on China has been enacted, the entirety of the reciprocal tariff regime has all been delayed, for 90 days. But I think the market's assumption is that as long as negotiations are ongoing in good faith, and frankly, U.S. equity markets are rising, that the Trump administration may be unwilling to put those tariffs back into place and allow for further delays. Additionally, on the other side, we have the 10% universal minimum tariff, which does not appear likely to be negotiated away, even in the completed and successful UK-US trade agreement. There was not a change in the 10% universal minimum tariff, even though there aren't major trading imbalances between the UK and the US. And so I think that's a good example of how the 10% universal minimum tariff is probably not going to be revised away. And while the reciprocal tariffs, which have since been delayed in all cases, those are where you could see concessions from the US in final deals. Although the reality is those tariffs are not currently in place. They're only at risk of being in place. The others to watch are sectoral tariffs and the fentanyl-related tariffs on Canada, Mexico, and China. The fentanyl-related tariffs are probably the one where you could continue to see potential further de-escalation, simply because if there is agreements related to border security or to China policies related to the drug, that could lead to further de-escalation. But on the sectoral tariffs is probably where you're looking at the possibility of further escalation. Now, of course, for markets, I think sectoral tariffs are maybe more tolerable simply because they're a more, they are a sectoral issue rather than broad based and blunt. Sectoral tariffs are a bit more targeted and potentially, not as wide reaching. They're certainly very important for the industries that are targeted. And of course, in Trump's case, the administration is looking at a lot of industries that have global importance. Auto tariffs are already in place, for example, albeit with recent carve outs and changes to maybe mitigate some of the impact. Pharmaceutical tariffs are still some that are being thrown around. Those still could be a source of potential re-escalation. And of course, you can't ever rule out the risk that the Trump administration changes its tone. And we've seen this a number of times already, that as we approach the early July deadlines for these 90-day delays, it's possible the Trump administration could consider maybe trying to turn up the volume a little bit to try and make sure to clinch some deals with traditional allies and adversaries alike. So we do think that we're in a de-escalatory phase. We probably remain in that phase. But my own personal worry is that we're probably at the peak in terms of what could realistically be expected for de-escalation. I just wonder if that story has now effectively run its course. And now markets are expecting, I think rightly so, that the next moves are going to be completed deals. It's just a question of really how long that takes. Now, Eimear, I want to go back to you and talk about one specific currency, because we just had elections in Central and Eastern Europe over this past weekend. And Poland is the one I really want to focus on because, we've had the election, the first round. We're now set up for a runoff election in Poland. And, the actual vote result, I think, was different than certainly what polls were saying and what markets expected. But an interesting currency reaction. I'd love to get your view on how currency markets have responded to this vote and what you think it means for the currency.
Yeah, absolutely. So I think Poland and the Polish zloty is kind of the exception to my bullish emerging market view. We did have the first round of the presidential election in Poland on Sunday 18th. And I would say, this just isn't, a ceremonial post the presidency in Poland. This was really a vote on whether, the government that was brought into power in October 2023 would actually be able to implement these kind of pro-reform, pro-EU manifesto policy that they were kind of brought into power to enact. So, the currency rallied strongly. It actually reached a 7-year high back in March, really on this hope that Poland was returning to the EU mainstream. It was bringing back democracy after 8 years of populist rule, which really saw, the judiciary in Poland being undercut, being staffed with, judges which were aligned with the political opposition, and state media being kind of transformed into what many thought was kind of a propaganda arm for the Populist Party at the time. So there really was a lot hinging on this vote. The government's candidate did actually win, but I would say where it differed significantly from opinion polls was that it was a very, very narrow win. So it was under 2 percentage points, where most opinion polls, going into this vote had a clear 4 percentage point win. And I would say, apart from that narrow win, what we saw more broadly was a shift away from the smaller left-wing pro-democracy parties to the far right. And so even though, the currency didn't really react, I think many currency participants may have thought, well, it's a narrow win, but it's still a win. But I think, when you look at the overall result, it's really showing that there's been a significant shift in voter preference towards the far right. And actually, what I think market participants may be overlooking is that when we move to the runoff round, effectively voter bases will be combined, really aligning between the two qualifying candidates. And when you break that down, when you aggregate, when you take all the voter bases across the coalition government's candidate and all those across the two main far right party candidates, actually the government's candidate is now at a deficit. And when you broaden that further, the far right against left-wing parties, that deficit really increases. So when we crunch the numbers, we do think, and we've held this view since February, that it will be, a victory for the opposition party. And what effectively that means is that the remainder of this government's term, that came in to power with so much kind of applaud from financial markets, that basically the opposition, they will spend the remainder of their terms with all their legislation for reforms really being blocked by an obstructionist president. And it also really increases the chances that you will get the populist opposition, the Law and Justice Party, actually being returned to power in the 2027 government election. So we think, the market is really underestimating that risk, perhaps because we had a bit of a turnaround in a similar election, first round election result in Romania, but that it will cause a significant sell-off in the Polish zloty. So we're looking for the Polish zloty to trade at 4.45 against the euro. So really a significant depreciation and a lot of renewed political risk actually being priced back into the zloty.
Yeah, I find it really fascinating just looking at the results there when you think about how the sort of Trump impact has really weighed on right-wing parties in a lot of local elections, whether it be Canada, Australia, and a couple of others. Really interesting as well, especially when we think about EM currencies there's these big global factors, but then you also really do have to pay attention to local factors, and the local differentiations between these economies. Really, really interesting and important to be tracking as we think about a broad view of the complex versus the dollar. So let's stop it there, Eimear. Thank you very much for joining. A really interesting conversation. And to our listeners, thank you very much for joining as well. If you enjoyed this podcast, please consider giving it a like and also subscribing to our channel so that you can get our latest content the moment it's released. Thank you very much.